deducted, and some key record-keeping tips that you can follow year-round that'll make the biggest difference. I'm a licensed attorney who has worked in the family child care field for over 30 years. For many years, I worked at the Child Care Resource and Referral Agency in St. Paul. For the last 5 or 6 years, I've been on my own as a consultant. I travel around the country doing workshops. I answer questions on the phone. If you have questions after tonight about this topic or any other business matter, I'm happy to try to answer your question. Here is my phone number, and here is my email address. I don't charge anything, so I'm happy to follow up with you if you have additional questions. I have a blog, a website, tomcopelandblog.com, where I posted hundreds and hundreds of articles on all aspects of the business side of family child care. Relative to this class, I've written a book, Family Child Care Record Keeping Guide, which lists over 1,000 deductions and explains how to keep records throughout the year. Every January, I revise an annual family child care tax workbook and organizer for people who do their own taxes. It takes you through each tax form line by line, and it explains all the changes in the tax rules. If you use a tax preparer, I revise the Family Child Care Tax Companion, which is a tool, small booklet, intended to educate your tax preparer so that they're not making mistakes when doing your taxes. All of these books are available through Red Leaf Press. I'm not providing you with tax assistance. I'm not doing your tax return. If you need a tax professional, you should consult one. So let's start off by asking a question so I get a little bit of sense of who's listening in. How long have you been a family child care provider? Less than 2 years, 3 to 10 years, 11 to 20 years, more than 20 years. And Andrea, I don't know if they need further directions. There it is. There's the poll. Just select one of the following, and we'll take a look at the results.
I'm just going to wait just another minute. About 85% of you voted, so take a little more time. Looks like a lot of, wow. So a third of you, 11 to 20 years, and almost 30% more than 20 years.
Okay. All right, that is helpful to me. We still have a bunch who are new, and we have a big bunch that are very, very experienced. Okay, terrific. That's what I wanted to know. All right, so let's jump in and talk about first some general record-keeping tips. Most people who do family child care do not enjoy record-keeping. I understand that. But you need to understand the significant tax benefits of doing good record-keeping. For every $10 of expenses that you claim as a business deduction, you're going to save about $3 to $4 in taxes. That's because you're paying Social Security tax, you're paying federal income tax, you're paying state income tax. And depending on your family's income, that represents about 30% in tax or about 40% in tax on your profit. On your business income minus your expenses is your profit. So a $100 business deduction represents about $30 to $40 in tax savings. So even though record keeping is not fun, and for most people it's a pain in the neck, it has a huge, huge payoff. Saving receipts has big benefits to you when you put it on your tax return. And because of this high tax rate that you're in, you're probably earning more per hour doing record keeping than you're going to be earning per hour when you care for kids. One of the handouts that I did is called Good Record Keeping Makes Good Financial Sense, and that handout goes into this point in more detail. General record keeping tips. You want to keep daily attendance records. You may already be required to do that on the food program, but keeping attendance records helps show how many hours you're working in your home, which we'll talk about later, and that is directly related to tax deductions. You want to keep records of all your income, obviously. You want to keep receipts for all your expenses. I suggest reviewing your records monthly so that you don't miss things. At the end of each month, I would suggest looking back and saying to yourself, did I record all the miles I drove for business? Did I keep track of all the meals and snacks I served? Did I keep all my receipts? Because if you realize you missed something at the end of the month, it's not so difficult to go back and reconstruct it, to make a note, to fix the records, to add to your records, to capture that. At the end of the year, it's more difficult. When you have a stack 2 feet high of receipts, that's much more difficult to try to figure out, did you miss something? Some providers use a business checkbook, but it's not required. In my experience, most providers do not have a separate checkbook for their business expenses, and it doesn't matter. You can put your income from your business on your business checkbook, your personal checkbook. It doesn't matter. If you ever get audited, they'll be looking at any checking account you have. So there's no rule about having to keep this stuff separate. It can be helpful in that you can put all your business income into your business checkbook. And there are some expenses that are just for business that you could write checks out of that. But most of the expenses that you have are business and personal. Toilet paper, light bulbs, cleaning supplies. So, which checkbook would you write that check out of? And it doesn't matter. It really doesn't matter. So it's up to you. There's some rules about saving records. You want to keep all your business records having to do with taxes for at least 4 years, because in Wisconsin, you're supposed to save your Wisconsin state tax information for at least 4 years. And since part of your Wisconsin tax return is based on your federal tax return, therefore now you need to keep all your federal records for at least 4 years as well. Now the IRS can only audit your federal tax return back 3 years. You can amend your federal tax return back 3 years. So save everything for 4 years to make sure you're covering yourself. And this is discussed in more detail in the handout, What Records Should Family Child Care Providers Keep? All right. Record keeping is a matter of tracking income and expenses. So let's first talk about income. Any money you get from parents is income, whether it's a regular tuition every week, every month, whether it's a registration fee, a late pickup fee, a field trip fee, a you're giving me a headache fee, whatever money you're getting from parents is income. The copay from a parent who's on the subsidy program, that's income. Parent gives you a gift card, Merry Christmas, Happy Birthday, that's income. If a parent gives you a gift, a thing, a book, a scarf, some flowers that is not cash or not cash equivalent, like a gift card, that's not income. So they can give you presents, but if it's cash or gift cards, then you got to report it as income. Money from the food program is income, with the exception if you're getting reimbursements for your own children. Reimbursements for your own children are not taxable income. We'll talk about the food program later. Money from the subsidy program, whatever you're getting, that's income. If you apply for a mini grant or other grants or scholarships or things that you might get because you're in business, that's income. When you spend the money from the grant on something for your business, then you can deduct it following the normal rules of deductions. So I wrote a handout on, should you accept a mini grant? And the answer is yes, because even though you might, under certain circumstances, you might have to pay a little bit of tax when you get a grant. In most situations, you're not going to pay any tax because you turn around and use the grant money for something that's exclusively for business. You wipe out all that income and no tax consequence. Now, there are two key rules that I recommend you follow to protect yourself if you ever get audited and the IRS wants to look at your income. You want to identify the source of all the deposits into any family or business bank account. Business checking account, savings account, business account, personal account. where does the money come from when you're putting the money in? So on the bank deposit slip or your check register, or if you're using a software program, Minute Menu, or any other program, make a note. This is a deposit from Mrs. Jones and Mrs. Smith. This is a food program check. This is a subsidy check. This is my husband's paycheck. This is money I got from a garage sale. Whatever, wherever you got it from, make a note so that later, if you had to, you could account for all the money coming into your various bank accounts. Secondly, and more importantly, at the end of the year, or if a parent leaves you in the middle of the year, get the parent to sign a receipt that indicates how much they paid you for the year and keep a copy for your own records. Typically, providers are doing this at the end of the year. Okay, here's how much you paid me for 2016, $1,000, $2,000, $4,000. Most providers are doing that and have been doing that for a while. But many are not making an extra copy of that receipt and getting the parent to sign it. You want a parent. So if there's any question later on about how much the parent paid you, you'll have a signed statement from the parent that said it was $4,000, not $5,000. Those two things here will protect you if you get audited and the IRS is challenging you in saying that you really earned more money than you really did. Lastly, most providers already have an employer identification number that you would want to use in giving parents that receipt. You never want to give out your Social Security number because of the issues of identity theft. Most providers already have this. If you don't, here's how you can get it. Go to irs.gov, do the search for online EIN. It'll take you 5 or 10 minutes to fill out the information, and you'll get an EIN number immediately over the internet, and you use that going forward. And that number will be good forever. Or if you want to call up the IRS, here's the number. They can take you through the form take you through the form online as you're talking to them. That's about all there is to say about income. That's pretty straightforward. So the whole rest of the webinar, we're going to be talking about expenses, tracking expenses. You want to keep adequate records to show that you had the expense, obviously. The best kind of record is a receipt. The next kind of record that you might want to have is a canceled check or credit or debit card statement. Now, a receipt is the best thing, but it's not the only thing. So just because you might not have a receipt doesn't mean you want to give up and not deduct something. The canceled check, the debit, credit card statement is better than nothing. Now, it's probably going to say, you know, Walmart, $50 on there, and the question will be, well, what was that? Was that shotgun shells or baby wipes? It's not clear if it just says check made out to Walmart or the credit card statement just says Walmart. But it's better than nothing. If you can remember and you're paying by check, I would try to use the memo line and write in children's supplies or daycare stuff or something. That can help if there's ever a question later. And if you have a receipt, the canceled check or the debit or credit card statement isn't necessary. What else? A written record. You go to a garage sale. You buy something on Craigslist. You buy something on eBay. You may not have a record, a receipt. You may be paying in cash. So writing out your own note, your own record. Garage sale, July 23rd, east side of town, used high chair, $10 cash. Making your own note like that at the time or right after the time, that's going to be good enough. In addition, taking a picture of it would seal the deal. So if you've bought stuff so far this year and you realize you don't have a receipt or you don't have a credit or debit card statement that shows you paid for this, take a camera and go around and take pictures of these things that you've bought and write out a note now that says, to the best of your ability, when you bought it, where you bought it, how much it cost, and take a picture. And with that information, you should be fine going forward. Now, some providers worry that their receipts fade, and because you have to save them for now 4 years, that could be a problem. So to overcome that, you need to either make a photocopy of your receipts or scan them. If you scan them into your computer, that's an adequate record, and you don't need to save the paper anymore. The IRS says a scanned receipt is as good as the original. Now, if you're scanning receipts, that means you need to protect that. So don't lose a computer, or certainly download on a flash drive these records periodically. I would suggest at the end of the year putting a flash drive of all this downloaded records in a safety deposit box to keep it safe in case your computer is stolen or destroyed. All right.
Tom, there's
Yeah.
a couple questions about income, so I think that's back to the previous slide.
Great.
So
Great.
Parents should sign a printout with the total or an extra copy of their W-10?
The W-10 is a federal form that parents are supposed to fill out to give to their provider, that the provider would sign and indicate on that form their Social Security number or EIN number. That form doesn't have a place to put how much the parent paid. Now, parents aren't giving their providers the W-10, which they should be, but they're not. Instead, many providers give parents the W-10. The provider fills it out and says, hey, parent, here's this W-10 form you need. You can put on the W-10 just right across the top of it how much the parent paid. But again, what's important is to make an extra copy of that and get parents to sign it if you're using a W-10, and keep a copy. It doesn't have to be a W-10. It can be just any piece of paper. You could write out a note. Parent paid me $4,000, 2016, and date it, and have the parent sign it, and you keep a copy. Either way, there's no magic form that has to be used.
And so Mary just asked about signing it. So Mary, I think he just answered your question. And Tammy says on the Minute Menu, it prints the total on the top of what they pay.
Right. The Minute Menu software program, now called KidCare, we added the amount the parent paid and put that on the W-10. So when you print out the W-10, there it is. So you got a perfect receipt right there. Just make sure you get the parent to sign one copy. Yep.
And just one more quick question. What do you think about the app TaxBot?
Say that once more.
Rachel says, I've read your articles on scanning receipts, but I haven't heard what you think of the application TaxBot. Thoughts?
I don't know about that one. So I would appreciate whoever asked that question to send me an email, and so I can look it up, and I'll write about it. I'm not aware of it.
Rachel says she will. So that's all for now.
Great. Thank you. All right. So what else? All right. So we're in the middle of the year here. You're collecting these receipts. Before you store receipts away, I would urge you to follow what I'm saying on the screen here. That is marking your receipts. By that I mean you bought something, you're in your home, you're looking at the receipt. Before you put it away, say to yourself, is there anything on here that's 100% business that I never ever use personally? And that could be baby wipes, it could be toys, and you don't have kids of your own at home. It could be a whole variety of things. You never, ever, ever use it personally. It's not 95% business, it's 100%. If you have those kind of things, then you want to make a notation on that receipt. Put a big B next to that item, or 100%, or underline it in a particular color, something, so that you'll be able to look back on it at the end of the year and realize these individual items on this receipt were 100% business. Then you look at the same receipt and say, is there anything on here that was shared, that was business and personal? Cleaning supplies, light bulbs, toilet paper, and so on. And that's a lot of stuff that you might have around your house. So for those things, I'd put an S next to it for shared. Everything else on the receipt would be 100% personal, your hairspray, your clothing, not deductible. So 100% business or shared. That's what you want to capture at the time you bought the thing. Then put the receipt away and put the receipt into folders of similar category of expenses. Put all the toy receipts together, supplies together, utilities together, etc. Now, it's not uncommon for a receipt to have on it more than one category. One receipt, you got some toys and cleaning supplies. So which folder do you put it in? Do you put it in the toy folder or the cleaning supply folder? Well, the answer is it doesn't matter. It doesn't matter what you call things, what category you put them in. Because if you think about it, all these categories that will show up in your tax return eventually get added together. So whether you call all the items on the receipt toys or whether you call them all cleaning supplies doesn't matter. So just make a decision. Let's call all this toys and put it under the toy category or cleaning supplies. And then at the end of the year, you'll lump all them, you'll add all the cleaning supplies together, and maybe there's some toys in there. It doesn't matter. So don't worry about that. Don't spend extra energy trying to break out receipts into more than one category. All right. Now let's move on and talk about claiming deductions. There's a 3-step process for claiming all expenses except cars and food, and those we'll talk about at the end. So the process is this. First, we need to know, is something deductible? Then we need to know how much of it is deductible. And lastly, when can I deduct it? And I got a question here. I received a call from H&R Block. They said, my Social Security number, how do you protect parents from giving okay, the problem here is you won't know what parents are putting on their tax return in terms of how much they paid you. You know, they paid you $4,000, but they're reporting on their tax return $5,000. You'll never, you can't look at their tax return. You just don't have any control over that. So how do you protect yourself? The only way to protect yourself is to get that receipt signed by the parent that said they paid you $4,000. If the parent claims $5,000 or anything more than what they actually paid you, then there's a risk that the parent or you might get audited. If that happened, you would probably be suspected initially of not reporting all your income, because that's how the IRS and the state of Wisconsin would think. Providers don't necessarily report all their income, so that's what you're doing. And you would say, no, here I cared for 5 families that year, and here are receipts signed by the 5 families indicating for each of them how much they paid me, $4,000 for this parent. And so your number on your tax return accurately reflects how much you got from parents, and you can prove it. Now the parent who said they paid you $5,000, they're in trouble. They're in big trouble because they can't prove that they paid you $5,000. So that's the only way you can handle that situation. All right. So let's continue. Is it deductible? So this is fundamental. You are entitled to deduct expenses for your business that are considered ordinary and necessary for your business. That ordinary and necessary language is in the tax code. What does ordinary and necessary mean? It means typical, helpful, appropriate, useful for your business. What is your business? You are providing a home learning environment for children. That's your business. Parents expect you to maintain your home as a home. If they wanted a child care center, they'd go to a child care center, but not come to your family home. So anything that helps you clean, repair, or maintain your home as a home is ordinary and necessary. So, do parents drive by to see what your house looks like before they're going to enroll their child? Yes. Are you required to play outside with children, have a safe place to play for kids? Yes. So, ordinary and necessary expenses would include a lawnmower, gas for the lawnmower, repairing the lawnmower, paying somebody to mow the lawn, a snow shovel to shovel your driveway, a snow blower, paying somebody to plow your driveway, painting the outside of your house, cleaning your windows, fixing damaged shingles, putting up a fence, painting the fence, the welcome mat, the doorbell, the street sign. All of these things are ordinary and necessary in your particular business. Parents come into your house. They come into the living room. You're providing a living room environment for children. Do parents sit down in the living room? Do you have interviews in the living room? Are kids playing in the living room? If you took everything out of the living room, all the furniture, everything off the walls, everything, and just had a couple chairs in there, is that family childcare? I don't think so. Children learn a lot from the environment that they're in, and they're in a home environment. So what's deductible in your living room? Everything. Curtains, shades, blinds, pictures on the wall, lamp, rug, end table, chairs, sofas, screen in front of the fireplace, decorations on the fireplace mantle. All that goes into making that environment one that children learn from. The bathroom, towels, washcloth, soap, toothpaste, toothbrush, toilet paper, light bulbs, rug on the floor. Is there a bathroom scale in there? Are kids weighing themselves on the scale? If not, put them on the scale. I need the deduction. Get on the scale. A garden hose, wheelbarrow, rakes, shovels, on and on and on. The bigger items include property tax, mortgage interest, rent if you're renting, utilities, gas, oil, electric, garbage, water, cable television, house insurance, house repairs, house depreciation. We're talking thousands and thousands and thousands of dollars. Let's look at, a list of some very common deductions. The playroom, everything in the playroom. Outdoors, talked about these things. We've talked about all this stuff. Garage, basement, tools, freezer, garbage can, bicycles. If it has anything to do with your house, it's probably ordinary and necessary. It's probably easier to talk about what's not deductible. You can't deduct your clothing. You can't deduct your bed in your bedroom if kids don't sleep on your bed. If kids do take a nap on your bed, now you can deduct the bed, including the sheets and the pillowcase and the pillows and the comforter and the rug on the floor to walk to get to the bed. Your books that you read at night that don't have anything to do with your business, your hairspray, your toothbrush, you can't deduct the personal stuff. You have a television in your daughter's bedroom and the kids don't go in the bedroom, obviously they can't deduct the television in there. But everything else, all the kitchen pots and pans, silverware, everything. So that's why I want to save receipts for everything. In my opinion, it's easier to get into a habit of saving receipts for everything rather than worrying about whether or not a particular receipt is deductible and then deciding that you should save it. Just save everything. Just throw everything in the pile. At the end of the year, you'll sort through the stuff and say, okay, some of this stuff I can't deduct. Fine. But here's why I think it's better to do that. You buy a present for your own child, Merry Christmas, Happy Birthday. And you're thinking personal. It's for my own child, so you're not saving the receipt. But 1 month later, 6 months later, your child plays with that toy with the daycare kids or brings that toy out into the daycare room for the kids to play with. Now that is an expense for your business. Now it's being used in your business. Now you can deduct part of it. So what was not deductible when you bought it becomes deductible later. And I think it's hard to anticipate how something might be deductible later. So just save the receipt now. If you don't use it for your business until next year, you can deduct it next year. All right. How much is deductible? How much is deductible? Let's see. We got another question here. What should we do with 2015 receipts that have been deductible but were missed last year? That's a good question. So you realize, I bought some stuff in 2015 that you used in your business last year, but you didn't deduct. You can't then claim them in 2016. But depending on how much you missed, you can always go back and amend your return using a Form 1040X. And in my tax workbook, there's a whole chapter on this form, but it's pretty straightforward. You would simply go back and refile the forms that were affected by this change. Let's say you forgot to deduct a whole bunch of household cleaning supplies, $200 worth of cleaning supplies, I don't know. And so you'd simply refile your Schedule C and add to it $200 more of cleaning supplies. That reduces your profit, that reduces your Social Security tax, your income tax, and you get a tax refund. I've amended my tax return when I realized I forgot to include something, and I got the refund. So remember, for every $100 of a deduction that you missed, you would get a tax refund of about $30 to $40. So this may well be worth doing. Okay? All right.
And Tom, just one more thing so Sarah's asking, she purchased flowers this spring for the front of her home. Is this 100% deduction or shared expense?
Well, that's the topic we're jumping into right now. So up until this point, I've said, is it deductible? Yes, it's probably deductible. But now we need to go into, well, can I deduct all of it or part of it? And so flowers would be one example here. How much of the flowers can we deduct? And the answer is, if you're never using it for your business, you can't deduct it. So flowers that you're planting in the front yard, that's not exclusively personal because the parents see it, the kids are walking by them. Maybe you're even talking to kids about flowers and explaining flowers, and maybe you're even incorporating flowers into your business. But even if it's just flowers in your front yard, that's not exclusively personal. Is it exclusively business? Well, no. Flowers in the front yard, no, because you don't close your eyes on Saturday and Sunday and never look at the flowers. You're certainly getting personal use out of the flowers. So it's not 100% business. 100% business would be things that are never, ever used personally. And the third option would be it's shared. It's partly business and partly personal. And if that's the case, we're going to use what's called a time and space percent to know how much of that we can deduct. And we got another question, does filing an amendment make you more likely to be audited? No, it does not. So I would not hesitate to amend your tax return, assuming you have the records to support it. So you have the receipts for things, don't hesitate to amend. All right, so let's explain these three choices a little bit more. 100% personal, items used exclusively for personal use, you can't deduct. Your clothing, jewelry, hobbies, motorcycles, a bed not used by daycare children. An item is deductible based on how it's used, not why you bought it. So, the first television in your home is used by your business, children, and your family. That's a shared expense. You buy a second television that's in your son's bedroom that only he uses, then that's 100% personal. You can't deduct it. The fact that you didn't buy something except for the fact that you were in business. I'm buying this because I want it for my business. That doesn't necessarily make it 100% business. The question is, how do you use it? Oh, this toy would be terrific for my toddlers. They're going to love this toy. But you have a toddler of your own, and your toddler is using the toy on the evenings or weekends. It's not 100% business. But I only bought it because of my business. Yes, but it's used business and personal. Therefore, it's not 100% business. It's shared. What about things that are used? Where are we here? Yeah. I don't know what happened to the header. This is 100% business stuff. Items used 100% for business can be deducted 100% as a business expense. Baby wipes and you don't have babies. Swing set and your kids are in college. Children's furniture and you don't have children. Play equipment, arts and crafts supplies, only used for business. Items used anything less than 100% for business can't be deducted as 100%. This is a common mistake made by new and experienced providers. Don't tell me your living room couch is 100% business. No. Provider went to a store to buy a rocking chair that she wanted to use for rocking babies, and she was going to put that rocking chair in the children's area that her family didn't go. Okay, it sounds like 100% business, but when she went to the store, they had a 2-for-1 sale. So she came home with 2 rocking chairs, and she put one of them in the children's playroom, but she put the other one in the living room that was used, obviously, business and personal. So she can't deduct what she paid 100% as a business expense. You can't say that was just for the business one and the personal one was free. No, you paid and got 2 chairs, so you have to split them out. One chair is 100% business. The other chair could be considered shared. All right? So, time, space, percent. So now let's talk in some detail about these shared items, because this is the single most important number you want to calculate correctly. It'll tell us how much you can deduct for items that are used both for your business and for your family. And there's a lot of stuff. We've listed some of these things before, the property tax, mortgage interest, etc. In addition, furniture, appliances, fence, supplies, toys, television. Many, many, many items worth thousands and thousands of dollars. The higher your time, space, percent, the bigger your business deduction, the lower your taxes. The time and space percent is made up of 2 functions, a time percent and a space percent. And once we know what those 2 are, then they get multiplied together. So the times percent is how many hours are you using your home for your business. And the space percent is how many square feet are you using in your home for your business on a regular basis. So let's talk about time first. There's 2 kinds of hours to think about here, and I think it's helpful to think about it this way so you don't miss things. Hours children are in your home. We want to capture those hours from the moment the first child arrives until the last child leaves. And then hours children are not present in your home, but you're still doing some kind of business activity, cleaning, activity preparation, meal preparation, parent interviews, parent phone calls, record keeping, internet activity. The time you're spending right now listening to me, assuming you're in your home, you can count this time as part of your time percent. And if you count the time, that will help reduce your taxes. So as I'm going to explain in a minute, you're going to take the hours kids are not there in your home and capture those hours by tracking very carefully how many hours you're spending for at least 2 months of the year. All right, so let's go into this a little bit more. Hours when children are present. Let's say you're caring for kids from 6 in the morning until 5 at night. That's 11 hours a day. That's the average number of hours providers nationally care for children, 11 hours a day. That's 33% of the year right there. So your hours may be listed in your contract, but I would recommend you keep daily attendance records if you're not already doing that. Most people are. You don't need to track every single minute. You don't need to say 5:58 a.m. to 4:53 p.m. Okay? If the kids are there 6 to 5 and occasionally you work a little bit longer, a little bit shorter, then that's not a big deal, 11 hours. The IRS doesn't require a sign-in, a sign-out sheet, but it seems to me an increasing number of providers are doing that. Now, I would pay a little bit more attention to pickup time. Let's say the parents are supposed to pick up at 5:30. However, whenever your pickup time is, in my experience, for many providers, that doesn't represent the minute that the last parent walked out of your home. Just because that's your pickup time, parents are there beyond that time, usually on a pretty regular basis. So let's just say, in this example, one parent is regularly late and doesn't leave a provider's home until 6 p.m. You want to track when the parent walks out, not when they sign out. Now, the Minute Menu software program, now called KidCare, will launch the accounting upgrade of this next month. And one of the things in the new system is the ability to access the software program, KidCare, that's what it's called now, from any platform. In other words, an iPhone, an Android, a tablet, a Mac, a PC, any way you can get onto the internet, you can get into KidCare. And it has the ability, when the child is signing out, for you just to push a button next to that child's name, and that will capture that moment, that minute, 5:48 p.m. And if you push the button when the parent is there to pick up the child, but then the parent turns around and starts talking to you for another 20 minutes, and then finally leaves, you can go back and push it again, and it'll record those extra 20 minutes. So it's going to be a much easier job to capture all these additional minutes that parents are in your home. So how significant is this? An extra half hour a day, let's say the last parent is never leaving until 6, 5 days a week is equal to 1.5% of the year. Now, that may not sound like a lot, but it really is, because if your house-related expenses are $20,000, property tax, mortgage interest, utilities, house depreciation, that's not an unusually high number. 1.5% of that is $300 additional deduction, which is probably around $100 more tax refund. So I don't think it's a lot of extra work to pay attention to when the last child is really leaving and to record it at 6 rather than 5:30. The parent doesn't show up until 9 o'clock at night because they forgot where you live. You can count those 3.5 extra hours. The child stays overnight. You count all that time. The child comes over on Saturday to play with your child for a couple hours, even though they're not paying you extra for that. That's part of the service you're offering. You can count that time. So maybe this is not something that's every day, but maybe it's 2 or 3 times a week. It's still worth keeping track because of the potential impact that all these hours can make. Question here. Parents who are not with your program at the end of the year, do you still have to send them a W-10, or can you ask them to stop in so they can get a signed one? Well, you're not required, I didn't say this before, you're not required to give parents a receipt. You're not required to give parents a W-10. I think it's a good practice. I think it's a good thing to do. I think it's the professional thing to do. You're on good terms with parents. Give them this information. They really need it. And get them to sign it. Now, a parent is left. Going forward, if a parent is leaving you in the middle of the year, I would try to get them to sign a receipt as they're leaving you now. So you don't have to worry about this at the end of the year. But, all right, they're gone. Are you required to contact them and send them a W-10 or some other kind of receipt? No. If you want to, you can. If you want to, you could mail them 2 copies of the W-10 or 2 copies of your receipt that you create and include a stamped envelope and tell them to sign 1 copy and return the one to you if you want to do that. If you don't feel comfortable doing that, you could say, parents, you want a receipt, stop by my house, and then get them to sign a copy that way. It's up to you. All right. Now, we just talked about hours kids are in your home. What about all the other hours you're in your home doing some other kind of business activity? This is a big deal. What are you doing that's related to your business when kids aren't out there? You're cleaning. You're cleaning in the morning before they arrive. You're cleaning in the afternoon after they leave. You're preparing meals on Sunday night. You're planning meals or preparing recipes, shopping lists. You're unloading food from the grocery trip. Activity preparation, interviewing parents, talking to parents on the phone, keeping records. It takes you an hour a week just to figure out how much time you worked that week. That's another hour. Food program paperwork, time on the internet. And I did a handout on this. Track all the hours you work in your home. There's a spreadsheet that I created that you could use to do this. So, here's our second poll question. How many hours in a week do you think you do business activities in your home when kids are not present? And just make a guess if you don't know. 1 to 5 hours a week, 6 to 10 hours, 11 to 15 hours, more than 15 hours. So take a second here to answer.
Just about everybody's voted. It looks like most people are saying 6 to 10 hours, Tom. Here, I'll share the results with you.
Aha. Well, this is very interesting to me. There's only been one national survey asking this question in any detail, and the average amount of time was 13 hours a week. And so I'm assuming people here are guessing. I don't know if there could have been another question whether you really track this or not. In my opinion, most people underestimate how much time they're spending on these activities. So how can we do this? How should we be doing this? First of all, you can't count hours when you're away from your home, even if it's some business activity. So when you travel somewhere to go to a training, you can't count the time because you're not in your home, because these are expenses related to your home, and you got to be in your home for these to count. So shopping, no. Going to the library, no. You can't count time twice. You're cleaning while kids are sleeping. Well, you've already counted that time with kids being there. You can't count it again. You don't have to be the one doing the work. Your husband gets up on Saturday and cleans up after the kids. Fine, you can count that time. If you and your husband get up together and clean together for an hour, it's still just 1 hour. Clock went around once. If you clean for an hour and then watch him clean for an hour, that's 2 hours. Don't work together. This is a big deal about counting these hours. So how do we keep the records of this stuff? I'm not going to tell you to try to track this every day, 12 months a year. That's crazy. You'll go out of your mind. Although I've seen a few providers who did it every day. Tracking the hours when kids are in attendance is pretty straightforward. But tracking the hours when children are not present is harder. So what I would recommend is take 2 months and carefully track these hours when kids are not present for those 2 months. So you can take August and November, whatever. And on a calendar, make a note of the time of day, because we want to see that it wasn't done when kids were there. So you'd say 5:30 a.m. to 6 a.m. cleaning, and kids are arriving at 6, that kind of thing. So you try to do the best possible job you can of keeping on top of this for 2 months. Then use the average from those 2 months for the rest of the year. So if in August you work 44 hours that month, and in November you worked 46 hours that month, the average is 45. So now you would count 45 hours a month for 12 months. This is the single most important thing you can do to reduce your taxes. And the KidCare software is also going to make this easier, because in the same way that you can push a button and indicate, when the child actually left and arrived, you can go into that software, and now you're upstairs, let's say, and you got your phone upstairs, and you're cleaning or you're doing some paperwork, you're doing something, and you just go on, pick up your phone and push a button, and the time starts to record. And then once you're finished, you push a button again, and that'll capture the 20 minutes, the 30 minutes that you worked. Now, if you push the button to start the activity and then you forget to push the button to stop it, or you don't remember to go in there and use the software to record this, you can always go back in there and enter in the exact time. Oh, I forgot to record this. Okay, when did I start? I think it was 6:45 at night. And when did I finish? 7:15. Okay, that's a half hour. And you just plug it in there into the software. And that will capture all those hours and add it together with all the other hours of business activities, including when kids are there.
Tom, there's a couple questions about time from Amy. How do you count laundry time? The washing machine is washing nap bedding only, and I'm watching TV. Can I count that? And then a follow-up from...
Yeah, let's take it one at a time.
Okay.
You can count the time that you're gathering together stuff to wash, assuming that stuff is daycare stuff. You can count the time you're putting it in the washer. You can count the time you're putting it in the dryer. But unless you're standing in front of the washer and dryer watching it, you can't count the time that it's spinning around. If you went upstairs, you said you went upstairs and watched television, well then no, we can't count that time. If you went upstairs and were doing record keeping, then you could count that time. So just because the washer is rolling doesn't mean you're using your home for business. I wouldn't count that.
And you just answered her second question too.
Okay? All right. All right, that's time. Hours kids are there, hours kids are not there, 2 months average, add them together, total number of hours in the year. As I said, providers average 11 hours a day caring for kids, and the average of 13 hours a week is 8% of the year, plus the 11 hours, which is 33%, 41%. A typical time percent for most providers is somewhere between 35 and 45%. It can be lower. You're only working part-time. You're not caring for a whole lot of kids. It can be higher. I've won 2 tax court cases in which a provider was caring for children 24 hours a day, 7 days a week. In other words, she was always using her home for business. And her time percent was 98%. And the only question in the audit was, can she prove it? Can she show records that indicate that she was actually caring for kids all those hours? And she did. So we won a 98% time space percent. The other provider compromised because her records weren't as good. We compromised at 93%. So don't let somebody tell you not to claim a percentage above 40%, 50%, 60%. No. It's whatever it is. If you've got the records, claim it, because this is a big deal. This will help you significantly. Can you count the time your husband mows the lawn? No. You can only count time if you're doing an activity that you wouldn't be doing if you weren't in business. Mowing the lawn is something you would do anyway, so you're not spending more time because of your business. But shoveling the snow at 5 in the morning before the kids arrive, yes, because you wouldn't be up at 5 in the morning shoveling. But mowing the lawn, no, you're doing that anyway. Taking out the garbage, no. Now you're cleaning the bathroom and the kitchen on Saturday when kids are not there, and it takes you an hour. Can you count the full hour? I don't think so, because some of that time you would normally clean your bathroom and your kitchen, but you're probably spending more time cleaning your bathroom and the kitchen because you're in business. So we got to be reasonable here. Not every single minute of cleaning should be counted. All right. Second part of this formula is space. So we want to look at each room in your home and ask yourself, am I using this room on a regular basis for my business? Because if you are, we can count the square feet in that room as business space. What is regular use? It's defined as about 2 to 3 times a week. It doesn't have to be 10 hours a day or 5 hours a day for it to be considered regularly used. It doesn't have to be every day. Every other day, a child takes a nap in a bedroom for 20 minutes. That's clearly regular use. You can count rooms even if children are not present. You have a laundry room in the basement. Licensing says you can't have children go down there because you don't have proper exits. Well, are you using a laundry room for your business? Yes. 2 or 3 times a week? Yeah, probably. Okay, count the laundry room. The same thing with an office or a storage room. You must include both the garage and the basement in the total square feet of your home. Most providers, however, would also be able to count those spaces as regularly used. Basement. You got the hot water heater, you got the furnace, you got a laundry room, you got storage areas, you're storing Christmas ornaments, you've got a tool bench and all the stuff you use to maintain, repair, clean your home, you got food stored down there, whatever, you got toys, regular use. The garage, you got cars, you're using car for your business, garbage can, recycling, lawnmower, garden equipment, wheelbarrows, etc., cribs, cots, bicycles, toys, outdoor toys. typical garage, you would count the garage as regularly used. It's not unusual to consider every room in your home as regularly used. This information about space and time is put on IRS Form 8829, Expenses for Business Use of Your Home. It's the top of the form where this information goes. Something we don't need to worry about this time of the year, but that's where all this is going to be entered. So we're multiplying the time percent, for most people 35 to 45%, somewhere in there, times your space percent. For most people it's going to be 90 to 100%. So if it's 40% time and 90% space, that's 36% time space. We don't have to worry about this formula at this time of the year. The key thing is, are you keeping good records of the hours you worked, and are you thinking about regular use and counting all the space? Now, there's a special rule here, an exclusive use room rule, which would allow you, if you qualify, to claim a much higher time and space percentage. This has a great benefit for providers who qualify. In order to use this rule, you have to have at least one room in your home that you never use personally. It's exclusively business, a playroom, a storage room, a crib room. Providers who don't have kids of their own at home are more likely to have this kind of space. Often it's a basement area, downstairs area, set up as a children's playroom. It's a strict rule. So if you go in there, or your children go in there on evenings or weekends and watch TV or do something personal down there, and no, you can't use this rule. It's very, very strict rule. But if you have it, it will make a difference. And so I don't want to go into detail in the formula here, but and we're in the middle of the year, so if you haven't been using a room exclusively so far this year, it's too late for 2016. Thinking forward to 2017, you might say, well, gee, I have a room that, yeah, I've used a little bit so far this year. Well, maybe next year you want to make a strong effort not to use it personally, because it can make a big difference. It can jump your time space percentage 4, 6, 8% quite easily. And I've seen providers who, as a result of this rule, have a time space percent now over 50% because of it. Now, you might have a basement area or a playroom area in which in one corner of the room there's something personal. So you have an open basement area that has a furnace and a laundry room at one side of the room, but it's one open area, right? Now, if you looked at the whole basement, we'd say, well, that's not an exclusive use. Let's say the area not taken up by the laundry room and the furnace area, let's just say, is a dedicated daycare space, playroom, 100% business. Again, if we looked at this as one room, it's not an exclusive use room. But you can draw an imaginary line and divide the rooms into two. The space taken up by the furnace area and the laundry room, we can call that space regular use by just drawing a line around it. No walls are necessary. And then say the rest of this area is an exclusive use room. So we just create two rooms and then take advantage of this rule. That's a lot of providers are in that situation. So don't think you don't have an exclusive use room simply because there aren't walls separating rooms. You can create your own walls.
Tom, there's a couple questions about time here before you go on.
Fine.
The next one's.
Go. Yeah.
Let's see. I think this is related. Mary says, exclusive room use. Just wondering if you walk through the exclusive room to use the bath connected to it. Is that exclusive? The playroom is used. I assume that's what you're walking through, Mary. The playroom is only for childcare.
Believe it or not, there's an IRS court case in which walking through an exclusive use room to get outside or go to another room does not destroy the exclusive use of that room. So it's okay to walk through the room. Don't sit down. If you feel like you're going to fall down, get out of the room to keep it exclusively business. So walking through is good, is fine.
Norma wonders, my son cleans the daycare floors Monday through Friday for about an hour. Can I claim that time?
Assuming he's doing the work when kids are not there. Tell me again what the work. What is he cleaning?
The daycare floors Monday through Friday for about an hour.
Yeah. Now, if it's a room that's regular use, and then yes. If it's an exclusive use room that he's cleaning the floors, then we don't care. It doesn't matter how much time is spent in the room, because as long as it's dedicated for business use, whether kids are in there or whether you're going in there afterwards to clean or going in there afterwards to do record keeping, we don't need to worry about tracking the hours, because under the formula, the new formula for this rule, it's going to be considered 100% time because it's dedicated to business. So we don't need to track the cleaning time or any other time in an exclusive use room. We just say, is it an exclusive use room? Let's say it takes up 10% of the home. Therefore, we get 10% as an exclusive use percentage. Then we're going to do a time space percent where we worry about time for the rest of the home, and we're going to add these two percentages together. So I didn't mean to go into the formula there that this is the time of the year not to worry about that, but time spent in an exclusive use room does not need to be tracked.
Another question, can you count half the time you're mowing since it's for daycare and home?
No. Unless you only mow half your lawn when you're not doing childcare. So no.
So maybe, is this the same, how would you track time if it's during business hours if my husband needs to shovel the driveway?
Yeah. If your husband's shoveling the driveway while kids are in your home, you can't count the shoveling time. So you can only count time for all these other activities when kids are not there. Now, if the husband is shoveling the sidewalk and the provider is at the same time doing record keeping, and this is before the kids arrive, and you can't count the time twice. So if a half hour goes by and he's shoveling for a half hour, and during the same time you're doing record keeping for a half hour, that's a half hour. If kids are there and the husband is shoveling, you can't count any of the shoveling time.
Kelly Matthews did a whole webinar on time space percentage, and we went through this step by step, so that might help some of you. That's on our training archive page, just so you know.
Oh, great.
And then one more question before depreciation. This is about clothing. Can I deduct my clothing since I need to dress in an appropriate professional way for meeting the needs of kids? Mary was told this, apparently.
Yeah, the short answer is no. So under what circumstances could you deduct clothing? You could only deduct clothing for something that was not suitable to be worn outside your home. In other words, a uniform. And the only thing that I think meets that definition in family childcare are scrubs. So if you buy clothing that you only wear during daycare, that's the only reason you bought it, you only wear it during daycare because it gets all messed up and you just, okay, that's my daycare stuff for clothing. It's not deductible because it's not clothing, because you could wear it outside of your home. It's not a uniform. It has to meet the definition of a uniform to deduct clothing. Now, some providers have shirts or sweaters that they have on their logos, business logo, your daycare association name on there, or children are my business, or whatever, something on there that designates you as a child care provider or says something about children. Then that's advertising. It's not clothing. It can't be deducted as clothing, but you can deduct it as advertising. So I know that, some people get frustrated because, wait a minute, all this stuff I'm buying to wear, to be professional, I understand. But since you could wear it outside to go shopping, you can't deduct it.
That's all for now.
Okay. All right. So now we're going into the third part of this exercise of claiming deductions, which is when can I deduct? Can I deduct it right away in the year I bought it, or do I have to depreciate it? Do I have to spread that deduction over time? And there's been a significant change in this rule as of last year, late last year. Old rules going back 20 years said if you bought something that cost more than $100, you had to depreciate it with some exceptions. Then a couple years ago, they said, well, we're now going to say if you bought anything less than $200, you can deduct it in 1 year. More than $200, you'd have to depreciate it. In November of 2015, they upped the $200 amount to $2,500, which is, wow, this is a big deal, meaning that there are very few things now we have to worry about depreciating. If you bought something that individually costs less than $2,500, you can deduct part of it or all of it in 1 year. If it's more than that, you have to depreciate it, but again, there are some exceptions. So what are the kinds of things that might cost more than $2,500? These are the categories of depreciation: office equipment, personal property, furniture, appliances, land improvements, fences, patios, driveways, home improvements, something that's essentially increasing the value of the home, adding a deck, adding a room, remodeling your kitchen. The house itself, we depreciate the house, and cars, and we'll talk about car depreciation later. So here's the big thing. So I want to, this gets a little tricky, so I want to make mention of it. And what I want you to remember is if you're buying things that cost more than $2,500, you want to talk to your tax preparer because the rules have changed so much that there are several different ways that it might be possible for you still to deduct these in 1 year. And before I describe what's on the screen, I forgot to say, if you went to buy some furniture for your house and you got a receipt that says furniture $4,000, since that's more than $2,500, you'd have to depreciate it. But if the receipt said furniture $4,000 and then below that it said couch $1,000, chair $600, table $400, if any of those items individually cost less than $2,500, even though the total is more than that, you can still write all of them off in 1 year. So you want to make sure that the receipt, the invoice, breaks things out, because if you break them out and they're less than $2,500, we don't have to worry about depreciation. What else? A repair has always been deductible in 1 year, regardless of its cost. So if you painted the outside of your house and it cost $2,000, $3,000, $4,000, it's always been allowed to be deducted in 1 year. There's never been a $100 limitation or $200 limitation, and there now is not a $2,500 limitation. If it's a repair, it gets deducted in 1 year. And for a house painting, you'd multiply the $4,000 painting your house by your time space percent, deduct it in 1 year. Now, a home improvement, a new deck, a new room, remodeling your kitchen, you must depreciate over 39 years. So there's a big difference here. If it's a repair, wow, 1 year, this is great. If it's an improvement, oh man, 39 years. So the new rule says this, and this is as of last year. They've expanded the definition of what can be considered a repair. If you replace, let's see, how can I say this? You need to think of your house as being made up of major components: the roof, the walls, the floors, the electrical system, the heating system, the cooling system, the plumbing system. Those are the major components of your home. Under the new rule, if you're replacing less than half of any one of those major components, it can be considered a repair. So you replace, under the old rules, if you replaced a couple shingles on your roof, that's a repair. Under the new rule, you replace all the shingles on your roof, that's a repair. If you replace the shingles and all the boards underneath it, essentially a new roof, that's an improvement, 39 years. Under the old rules, if you put in an egress window, that would have been considered a home improvement, and you'd have to depreciate it over 39 years. The new rule says if you're replacing less than half of the windows in your home, that's a repair. So you got 12 windows in your home, and you replace 5 of them. 5 of them this year, 5 of them next year. That's a repair, multiplied by your time space 1 year. If you put down a new wood floor or a tile floor in your downstairs area or in your living room, whatever, if the total square feet of the new wood or tile floor is less than half of the total square feet of your home, it's a repair. So wow, this is a big deal. Remodeling kitchens, remodeling bathrooms, I think we need to consider those as improvements. Now these rules are new, and they're not completely black and white. When I talked to the person who wrote the rule, I said, if a provider replaced 10% of her windows, is that a repair? Yes. How about 20% of the windows or floors? Is that a repair? Yes. How about less than 50%? She goes, well, maybe. She wouldn't say yes or no, but I think it's reasonable looking at the rule to conclude that it's possible. Now, there may be some future guidance coming down or tax court cases, or people might be writing articles about this that I'm looking for, paying attention, and if I see something that further clarifies this, I will write about it on my blog. And if you use a tax repair, I would certainly talk to them. In other words, if you've done some stuff that you say, well, maybe this is a repair, I don't know, is it an improvement, is it a repair? Talk to your tax repair and push them about, hey, there's this new rule, relaxing the definition, maybe it's a repair. Now I got a question here. A roof was covered under insurance, but there was still a $1,500 deductible. Is that a repair? Okay, first, if you have an insurance claim, the amount that you could deduct would only be the amount that you're paying out of your pocket, the deductible. So we don't worry about the rest of the cost. You can't deduct that. So in this case, you got $1,500. Well, I think we have to lump this together with the full cost. And if this was simply replacing shingles, then the answer would be that's a repair, $1,500 multiplied by the time space percent. However, if this was a replacement of the entire roof, the underboards and everything, then the $1,500 would be considered an improvement that you'd have to depreciate over 39 years. All right. So, making sense of these new depreciation rules. Most things don't have to be depreciated anymore. Anything less than $2,500. Okay, here's another thing that I don't want to go into detail because the rule is kind of tricky, but here's something else. You did some work. You put in a new deck, and it's more than $2,500, and it's not a repair. I mean, if you just fix the board, replace some boards, that's a repair. But you added a deck when you didn't have one before. Well, that's an improvement. It costs less than, if it costs less than $2,500, write it off in 1 year. It's more than $2,500. Okay, it's an improvement. Before you say to yourself, okay, I got to depreciate this over 39 years, there's this other rule that says, if the cost of your improvements and repairs in any 1 year was less than $10,000, then it might be possible that you could treat these as repairs. It depends on the cost of your house. And the more your house cost, the more likely you could write these things off as repairs. So I don't want to go into it in any more detail because it gets a little complicated. But so don't give up. If you have some home improvements, go back to your tax preparer and say, could this still be considered a deduction in 1 year? And I wrote about it last year, at the end of last year, on my blog and in my tax books. I'm going to be highlighting this in particular come tax season this time in my books and on my website as well. All right. Last two topics is car expenses and then food expenses. You're entitled to claim expenses associated with your car when you take trips that are primarily for business purposes. primarily means more than half of the reason that you're traveling was business. You're going to the bank to deposit money, business trip. You're going to the library to get children's books, business trip. You take children somewhere, take them to the park, the school, the library, you drive them home, business. What about this trip? You go to the grocery store, you buy business food and personal food, and then you drive home. Is that a business trip? Well, maybe. What's the primary purpose? If you're buying more business food than personal food, that's a business trip. But for some providers, you may always be buying more business food than personal food. If that's the case, don't try to claim every single trip to a grocery store as a business trip. 70, 80, 90% of the trips maybe, but never every single trip. The IRS is saying, wait a minute, some of these trips have got to be personal. All right. Keeping adequate records of these trips. You need to have something that shows you went to the store. What might you have? A receipt, a mileage log, a canceled check says you were at Walmart, debit or credit card says you were at Target, written records. You make your own notations. I went to a garage sale on Smith Avenue, and it was 28 miles. A calendar notation. You're writing on your calendar, park, school, library. You're not spending money so you don't have receipts or checks, but a notation on a calendar counts. Or you're making this record in Minute Menu in Kid Care. That'll record your trips. That counts. Photographs. Here we are at the park with the kids. We must have been at the park because there's a picture of it, so that's a trip. Get your kids together tomorrow. And depending on their age, say to them, we're having a memory unit. Where have we gone so far this year? Whoever can come up with the most trips is going to get a prize. Let's go. I need some more deductions. And some child says, oh, remember we went over here in February. Oh, I forgot about that. Write it down. Write it down. You do not need to record odometer readings to claim business trips. You just need to know how far it is. And if you weren't looking at the odometer reading when you made the trip, you can simply go on the internet, MapQuest, Google search, and put in the destinations, and voila, there's the miles. Somebody told me about an app, Mile IQ, which I'm meaning to check out very shortly and write about, because this provider was saying, hey, this is a really neat tool that can help me just track all these trips that I'm going on and keep the records. So I'm sure there are other apps out there that can make this easier. There are two ways to claim expenses for the car after you've determined that you've been making a bunch of business trips. The standard mileage rate for 2016 is 54 cents a mile. That's actually down from last year because of the price of gas has gone down. In addition, you can deduct parking expenses, the business portion of any car loan interest, and the portion of the vehicle property tax. I don't remember, maybe Kelly knows, I don't remember if Wisconsin has a tax when you every year pay for the sticker on your license plate. Are you paying a tax as well as the registration fee? Because if you are paying a tax there, you can also claim a part of that. And using this method, that's all you get. The second way of claiming car expenses is to claim a portion of all the actual expenses, gas, oil, repairs, car insurance, parking, tolls, well, you don't have tolls, depreciation on your car loan interest, car wash, jumper cables, ice scraper, membership in AAA, all that, the business portion. The business portion is determined by taking the number of business miles you drove and dividing it by the total number of miles you drove. So if you had 2,000 business miles divided by 10,000 total miles, 20% of all these actual expenses. Or if you're using the standard method, 20% of the car loan interest. That's the car. Food program. Food expenses. You're always better off in the food program. And I did a handout on this and several handouts on this general issue of the tax benefits of being on the food program. This one's called the tax consequences of food program participation. Don't make the mistake of not being on the food program because someone told you you're going to pay more taxes if you are on the food program. It's true. You will pay more tax if you're on the food program. But you're going to pay the tax out of the money you get from the food program, and you're going to have a lot more left over. So you're always financially better off. And don't let somebody tell you, well, this being on the food program will kick you into a higher tax bracket. Well, even if it does, you're only going to pay the higher tax on the amount you got from the food program, not a higher tax on all your other income. So there's just no financial reason why not to be on the food program. The money you get is taxable income, with the exception that I mentioned before, money you get for your own children, which you would get if your family lives in a low-income area or your family is low income. That money for your own kids is not income. There are 2 ways to claim food expenses. Standard meal allowance. If you use this method, you do not need to save any food receipts. Most providers use this method because of this. At the end of the year, you'll add up all the meals and snacks you served and multiply by an annual standard meal allowance rate. And here's the rate for 2016. $1.32 for all your breakfasts, $2.48 for lunches and suppers, 74 cents for a snack. This represents 1 penny more than last year for each meal and snack. Using the KidCare software, one of the problems with the Minute Menu program was if your sponsor did not want you to put in the extra meals and snacks that you served that you weren't reimbursed for, you had to record it somewhere else, and it was kind of awkward. Under the new KidCare system, you'll be able to go in the same place that you're putting in the reimbursed meals and snacks. You can put in the non-reimbursed meals and snacks, and the software will add them up and print out a report that tells you what you can deduct. Everybody is eligible to use the standard meal allowance method, whether you're on the food program or not. You can deduct up to 1 breakfast, 1 lunch, 1 supper, and 3 snacks per day per child if you serve that many. You can never deduct any meals or snacks served to your own children. Whether they're on the food program or not, doesn't matter. You can't deduct it. You can't food that you eat in your home. Now, the meals that you serve that are not reimbursed by the food program don't have to be nutritious. So, typical provider would serve breakfast, morning snack, and lunch. That's 3 servings a day, and you'd get reimbursed for those meals. But now in the afternoon, you're serving an afternoon snack. What are you serving? A popsicle. Well, that counts because you can deduct up to 3 snacks a day. And that meal or snack that is not being reimbursed can be whatever you want, because the IRS rules say you don't need to save food receipts. In other words, no menus, no recipes. We don't care what the food is. It doesn't matter what it is. So the popsicle is not credible. It's not nutritious. You can't deduct it. But you're not trying to deduct it. You're not trying to get reimbursed for it, rather. But you can deduct it. So who wants a popsicle? One provider said to me, at the end of the day, as kids leave, she hands out crackers. Okay? You're standing at the door and your kids are walking by, you give them each a cracker. 74 cents, 74 cents, 74 cents. This adds up. 1 snack a day for 1 child for the year is $190. That's a lot. And so you want to keep track of the meals and snacks that you're serving that you're not getting reimbursed for. And so I did a whole spreadsheet on this, track all the meals and snacks you serve children in your care, a little chart that you could use. Again, using KidCare, it makes it easy. If you're using a calendar keeper or other record-keeping calendars, you can use that as well. There's no magic about how you keep track, but you need a daily record. You need to say Sally, Monday, snack. Sally, Tuesday, snack. Sally, Wednesday, snack. It's not enough to say in your contract you serve an afternoon snack. You need to keep a daily record that records the fact that you did serve it. Now, many providers don't have this kind of daily record of these unreimbursed meals and snacks. What are you going to do? Well, What I would suggest you do, strongly recommend, is go back and look back for the first 6 months of the year. And for each child, on a separate piece of paper, write down, Sally, January. How many days was Sally here? In January, 20 days. And if you always serve an afternoon snack, and you know, therefore, that if Sally was there, she got an afternoon snack, that's 20 snacks in January. You do the same thing February, March, April. Now, if the child wasn't there in the afternoon, okay, that's not a snack. But you reconstruct, based on your attendance records, the number of extra snacks, usually it's a snack, that these kids ate so far this year. You didn't record it at the time, you're doing it now. Then take this total for Sally for the first 6 months, and now it shows, I don't know what, 250 snacks. Then go to Sally's parents and say, will you sign off to say, yes, my child Sally got these snacks for the first half of the year. The parents are going to know that their kids are getting these snacks. And that's your backup. Okay, you didn't record it daily, but you got this parent signature that you served 250 snacks in the first 6 months of the year to Sally. Now going forward, try to do a daily record showing that. This is a big deal.
Tom, I just want to jump in here. It's 8:01, and so for those of you that need to leave, that's fine. What you'll receive is an email an hour after I close the webinar that has the link for the survey and instructions in it. So thank you to those of you who have to go now. We appreciate your participation. I've got about 6 questions that I do want to ask, and so if people are able to stay on the webinar, I'm hoping Tom can get through just a couple more slides and then we'll ask those.
Yeah, we're just about done here, so go ahead.
Do you want me to ask the questions now, or do you want to get through?
Yep. Why don't you go ahead?
All right. So do you know when the new Minute Menu will come out for providers?
August. I don't know a day in August, but they tell me August.
Where do you claim the income from the food program? Under other income, we don't receive a 1099.
Yeah, most providers don't get a 1099. You can either put it under other income on Schedule C, that's line 6, or put it in the same line where you have the parent fees, line 1, either way.
If my husband picks up groceries for daycare, can that be counted as mileage?
If the primary purpose of him driving was to go get food for the business, then yes. If he's picking up food on the way home from work, no.
I recently bought curtains for living and dining room, and the total was $4,000 each room, less than $2,500. And I have a receipt that says this. So can I deduct the whole thing without depreciation?
Yes. You would multiply it by your time-space percentage and claim it in 1 year.
Can you deduct fixtures in a second bathroom not normally used for daycare?
Well, not normally used. See, if it's occasional use, I wouldn't count it. If it's regular use, if it's a couple times a week, I would go ahead and count and deduct part of the cost.
And I think you answered this, but I want to make sure for Kristen, if we replace our whole roof, do we depreciate it or is it a repair?
If you simply replacing the shingles, it's a repair. If you're replacing the roof, the underboards and the shingles, that's a home improvement, 39-year depreciation.
And we had to replace an old furnace and AC with a new one. Can I deduct that?
Well, you can deduct it, but you'd have to depreciate it because replacing a furnace is more than half of the major component of the heating system. I mean, it's the heart and soul of the heating system. So a new furnace I would treat as a home improvement, multiplied by your time space, depreciate over 39 years.
For the non-reimbursable snack that I claim Sally had every day, do I need to specify what she ate or just that she ate?
No. Just that she ate. So it's Sally's snack. That's all you need. You don't need a recipe, don't need a menu. We don't care what it was.
And then is there a place in the old Minute Menu to record the extra hours we work with cleaning, email, internet, or only on the new program?
No, under the old system, yes. There's a place under the tab that says time space percentage, and there's a little tab that says other hours and then you can write in. You'd have to write in the out. You'd say 7 to 9 a.m., whatever, doing this or doing that. You could write it in, and then it would count those hours. And yes, it's part of the old minute menu.
And any other questions from the audience? I don't have any typed in right now.
All right. Well, let me finish up because there's a couple more slides, and then I'll handle any last questions. Some providers use the actual food cost method rather than the standard meal allowance. If so, you would have to save all your food receipts, business and personal food receipts, and then estimate what you're actually spending on food for the kids. My record-keeping guidebook lists about 6 different ways to do it. It's more work, but if you feel like you're spending more on food than this meal allowance gives you, then use this method. All right, so here's the summary. The 3 most important things I've said. If you do these 3 things, this will make the biggest impact in reducing your taxes. Save receipts for all expenses associated with your house. Keep a daily record of all the meals and snacks you served, particularly those that are not reimbursed. Track all the hours you work in the home, particularly when kids are not present. Again, here's my contact information. I'm also on Facebook. Every time I post something on my blog, it'll appear on my Facebook page. I answer questions on Facebook as well. That's all I have. Good luck to everyone. Are there any last questions?
How do we go about purchasing the 2016 tax workbook?
Go to redleafpress.org. It will be available in January. When it comes out, I always post an article about it on my website. If you go to my website, you can, on the left-hand side, it says subscribe. If you put in your email address, it doesn't cost anything. Then you'll get an article. Every time I write an article, you'll get an email. Here's the latest article. So then you'll be notified by email, hey, the tax workbook is now available.
And is Kids Pro confidential only to the providers to view?
Yes. Somebody else asked that at a conference I was at. Any information you're putting into the Kid Care or Minute Menu, the accounting side, your expenses, your income, all that stuff, your food program sponsor cannot see it. Minute Menu cannot see it, because it's password protected. The only people who can see it are you.
I think that's it for now.
All right. Again, if you have questions later, here's my contact information.
Well, and I'm going to sign up for your emails and friend you on Facebook. I didn't realize that. So thank you, Tom.
All right. You friend me, I'll friend you.
Tom, thank you so much. It's amazing how quickly an hour and a half goes talking about tax deductions.
All right. Thanks, everyone.
All right.
Good night.
Thank you, Tom.
Thank you.